We're going to get started in 1 minute. I know that we've got a couple people just still trickling in, and we've got 1 minute till noon here, so I'll be back in 60 seconds. Okay, everyone. We are at the top of the hour here, and it's noon here in Vancouver. I know we're so lucky to have people from across the country joining us. I do see that people are still trickling in, but in the essence of time, we'll get started. First and foremost, I'm just going to check with one of the fellow panelists. Ryan, can you hear me okay?
I can hear you.
Okay, great. Well, thank you all for joining us here today. As I said, we are so lucky to have people from across the country here, and we've got an exciting hour of kind of learning and insights ahead of us. I'm going to take care of a few housekeeping things before I pass it over to our presenter today. And first, I'll introduce myself. So for those of you that don't know me, my name is Ashley Willer-Bowman, and I'm very happy to be the president of Crew Vancouver this year for 2020. And with that, I want to thank a lot of people that are making 2020 happen for Crew. So first, we'll start with our sponsors. And Ryan, I'll have you advance the slides since you're my Vanna today.
There we go.
Thank you. Yeah. So on this slide is a list of just fabulous companies, and we're so fortunate to call you all sponsors, and so appreciate your support. 2020 has been, a roller coaster of a year so far, and guys, we're not even halfway through it. And the work we're doing at Crew to keep our members, our community, and our industry engaged is extremely important now more than ever. So we do appreciate all your support. In addition, I just want to thank all of our volunteers that are the manpower that keep Crew Vancouver going. And although there's a lot of people that made today happen, I do have to recognize Sarah McNeil with Rennie, who was our event coordinator and put a lot of effort into making sure that we were organized and online and ready to go for today. So thanks so much to you, Sarah, and the rest of the team. So in the spirit of 2020, on a personal note, like many of us, 2020 has brought me a lot of change. From a professional point of view, I'm wearing lots of new hats. I'm looking at prop tech and how we align buildings to our new reality, which has been some interesting innovation we've seen come out of the last little while. On the personal front, I have discovered a new patience in myself to partially homeschool a 7-year-old, something I never knew that I would be doing. And I know many of you are joining me, like all working parents, in that multitasking world that we live in now. As well as I can say, I've never watched as many movies before in my life. So in my house, we are going back to what my son is referring to as the olden day movies, which includes his new obsession with the Back to the Future franchise. So to add a little humor to this, I did have to put in a few slides that reference Back to the Future. So Ryan will go to the next slide. So apologies for the low quality here. I couldn't find a higher res image, but for those of you that know the franchise, this is Doc saying to Marty, pick any year, it doesn't matter, just don't enter 2020. So 2020, you have taught us a lot. We are still at the learning curve, and I've seen people adapt with empathy, resilience, strategic thinking and such, and we are all going through this together. And I truly do believe by sharing and participating and learning from each other, we are all going to get through this in a more optimized manner day by day. And with that, I'm very happy to present our speaker, who will be sharing his thoughts on what we are seeing in the BC economy as it relates to real estate currently. It's a good day for me too when I can introduce someone that I admire both personally and professionally. So I'm very happy to call Ryan a friend, and we have done work together over the years. And I was going to read his bio here, but I'm just realizing, okay, I can move it. My speaker panel was over it. So who is Ryan Berlin? We're so happy to have him here with us today. And for the past 15 years, Ryan Berlin has worked closely with many of British Columbia's most successful organizations in real estate development, retail, and finance, as well as Canada's more forward-looking municipalities, regional governments, and crown corporations. As Senior Economist and Director of Intelligence at Rennie, Ryan and his team support the organization's consumer, developer, and consulting services with their evidence-based research and data-driven insights. So I'm going to hand it over to Ryan. Ryan, thank you so much for your time and expertise here today. But I do have to point out that the URL you are seeing on the screen here, the Rennie Intelligence URL, is chock full of amazing reports and insights that the team produces for our industry. So I encourage you all to take a look at it. And Ryan, correct me, there it goes. There is a sign up, and you can stay up to date with all the great work that the organization is putting out. Yeah. Okay, bit more housekeeping. Next slide. We could switch back.
That's what I've got for you, Ash.
Oh, we don't have the rest of the presentation?
We do after this.
Oh, okay. Okay, so just, I'll hand it over now then, but just a quick, one more housekeeping note, and then Ryan, over to you, is we're all getting so good at these Zoom calls now, and there is a Q&A function. We welcome any and all questions, and we're gonna try and get to as many of them as we can. So please do use that function, and we'll be monitoring it. And with that, Ryan, over to you.
All right, thank you very much, Ashley. Great to see you again. Haven't seen you for a long time. And yeah, thank you to Crew Vancouver for having me here today. In case it's not obvious, let me just start by saying that I work with a bunch of data geeks, and just to be clear, that is a compliment. I'll include myself in that group. And I think, obviously recognizing the gravity of our circumstances today, the fact that we're seeing widespread toll being taken on people's physical and mental health. There's a financial toll that we're all working our way through right now. But if I look at our company or our team, the intelligence team here at Rennie, specifically in a perverse kind of way, we feel like kids in a candy store right now. And the reason I say that is that, as we move through this crisis, we're now dealing with new data points, unexpected and extreme data points that we've quite frankly never seen before. And we're trying to work through the data and synthesize the data in order to better understand where we've come from, one, two, where we are, and then I don't want to say most importantly, but obviously all of us have our eyes looking ahead at where we might be going. Across all sectors of the economy, in real estate, what does that recovery look like when it comes, because it's inevitable, and when is it likely to come? So, I think as an organization, we have invested a lot in data and technology over the past 5+ years, and in some senses, it was all for a moment like this, unbeknownst to us at the time. But what we've had to do is pivot away from some of those traditional measures that we've used to assess the market that might be published, on a monthly or a quarterly basis. Things like wages and migration and construction activity, which all are very, very relevant to our marketplace and understanding the dynamics. But we've now pivoted more towards higher frequency data. So we still look at jobs, we look at wages, we look at migration, we look at all that stuff, but we're also now looking at other economic indicators and proxy indicators of economic activity on a daily and even in some cases an hourly basis. So we're going to go through a lot of slides here with a lot of data, and I would never profess to be a soothsayer insofar as our recovery, our path or our timeline are concerned. But what I do want to do today is look at some of the things that we can measure, give you a sense for what our economy and our market look like when we hit pause in mid-March, what we can measure now, how can we describe quantitatively what our current situation looks like, and can we provide some historical context for it? Because everybody's sort of saying, like, has anything like this ever happened before? Or, what did it feel like in 08, 09, 12 years ago when we went through the Great Recession? And how was that similar to or different from our current scenario? So we can look at some of that stuff. And then I also just want to touch on some of the questions that we're asking again, that we don't necessarily have answers to, but they're questions we're asking about how our economy is evolving, our society, and how our real estate market and markets are evolving as well, as we sort of look for those green shoots of a recovery. And then, as Ashley said, once we get through everything, we will have some time for questions. Okay, so let's start with what we knew to be true. So where was our economy, taking us up to March or mid-March? And, for 12 years, essentially, we had declining unemployment rates across the country. Here in Metro Vancouver, our unemployment rate as we got to the end of last year was sub 5%, and it stayed there through the first quarter of this year as well. So we had a very dynamic labor market. We had a lot of job growth relative to the supply of workers, and that led to fairly robust increases in wages. So British Columbia out to the right here, showing year over year wage growth, weekly wage growth for full-time work. And you can see a 4.3%, a little bit below the Canadian average. If we move forward a little bit past the end of 2019, that jumped up to around 9% growth in wages, nominal wages, to the end of Q1. Again, reflecting the high demand for workers that we were seeing within this local market. So we had sort of from a workforce perspective, from a labor market perspective, we were on very, very solid footing here in BC and in Vancouver. And we continued to grow. So, we were receiving 30,000 people in a single quarter towards the end of 2009 from international origins. That was the largest inflow of net international migrants that we've ever seen in a single quarter to BC. And most of those, 60 to 70% of those migrants are economic migrants. So they're coming to work. So they tend to be young, educated, they've developed skill sets, and they've got a certain level of wealth. And they come over and they help the economy to grow. And so, our population grew by 34,000 people in that last quarter at the end of 2019, which I believe was the second most additions we've made in any quarter in history, at least as far as records having been kept are concerned. So a tight labor market, strong in-migration, which obviously generates demand for housing. And as we looked at our residential market, and I will talk about the residential real estate market here quite a bit, because that is where I spend most of my time analyzing data. But when we look at sales through the first month of 2019, so that's the red line on this chart, and we compare it to the same 6-month period in 2018, you can see that we were below that previous year number in each of the first 6 months last year. And that trend was something that had established itself in 2018. So we all know we had in Vancouver particularly, but across the country, Toronto was another example specifically, where the resale market was slow. After big run-ups in 16 and 17. And so we came through the first 6 months of the year, and we were as we went through the year, we were closing what we call this negative sales gap, where the year over year sales were negative, were down. And through the final 6 months of 2019, we saw sales in each of those months exceed the number from the same month in 2018. And that continued into 2019, to the point where when we look at year over year changes in sales in the Vancouver region, we were at 9 consecutive months of rising sales. So demand was coming back into the fray. A lot of it is pent up demand. So if we looked at sales activity adjusted for population, and we looked at the last sort of 12 to 18 months and compared that to the historical average per capita ratios, we were significantly below, in a given month, between 5 and 45%. And so, as the population was growing, as we're getting older, having kids, divorcing, dying, our housing needs are changing. And so that pent-up demand was just starting to get re-released back into the marketplace through March. And so we saw it when we look at Vancouver as a metro area. we saw sales increases on a year-over-year basis everywhere, pretty much everywhere. Really robust changes from down south of the Fraser into the more historic core, the North Shore, you name it. We saw activity really increasing on the demand side of things through March of 2020. At the same time, we had dwindling supply, and part of that was because we had increased sales activity, so there was more demand, and it was whittling away the available inventory, and new listings weren't increasing appreciably. So we started to see, after, again, 18 months of expanding supply because of sluggish demand, we started to see inventory on the resale side become more and more constrained. So by the time March of this year came around, so we're only talking 2 months ago, we had 7 consecutive months of year-over-year declines in inventory. And again, we saw that fairly uniformly throughout the region. As expected, I always go back to this notion that supply and demand really does matter when you're talking about values or prices. And so what we had seen was a slowing. What these data show here is average monthly increases or changes in benchmark prices in the Vancouver region. And you can see that prices were increasing through 16 and 17, but at a slowing rate compared to 2015. And then that rebalancing of supply and demand, where we had, relatively little demand, comparatively speaking, a lot of supply, a lot of choice for buyers, and there wasn't a lot of upward pressure on prices. In fact, benchmark prices declined a little bit, but they declined by a little bit less in the first half of 2019, and then as we went into the second half of 2019, they actually started to increase because we saw those buyers re-enter the market. Our population continued to grow. Our labor market was quite strong and wages were rising. And then as we moved into the first quarter of 2020, we saw some really robust price growth. For a lot of us who work in real estate, it was like, okay, well, here we go. Now we're back into sort of more typical conditions after really, working through 18 months of a sluggish market. And so we saw these prices, between February and March, we saw prices increase, again, pretty much everywhere. In some cases, remember, this is month over month on this chart. So we're seeing some pretty aggressive price increases, certainly not sustainable in the long run, but in some senses making up for some of the declines that we saw in 2018 and the front half of 2019. So, just in a nutshell, because, we only have so much time here, that's what our economy and our region look like at the point in March when we hit pause. And that's what we did. We closed the borders. We told people to stay home, and then everything changed. And so that brings us to where we are now. And where we are now is in the throes of something that we're calling the Great Suppression. And it's a bit of a play on words following the Great Depression in the 1930s and the Great Recession in 2008, 2009. And we chose that term deliberately, suppression, because this is a unique downturn in the sense that it's policy-led. And while it's not being felt uniformly across sectors, it didn't have its origin in a particular sector. We just told people to stay home. We told businesses to close down. And so that approach, that origin has had some pretty dramatic impacts on all of us, to say the least. So I just want to take a couple minutes and actually just put it into a bit of context, because I get asked the question a lot, like, our current situation, well, how does it relate to previous downturns? And I think really over the past 100 years, we've had 3 big time economic downturns that are worth noting. We've had many more recessions along the way, but we had the Great Depression back in the early 1930s. And again, the Great Recession in 08, 09. And then here we are today, 2 months into our so-called Great Suppression. And so I think it's useful to just compare each of these downturns across some dimensions that help us better understand, how these downturns came about, what were the aggravating factors, contributing factors, how do we respond to it, and what can we learn from our situation. So when we look back at the Great Depression, the night after World War I, the 1920s were an exuberant time. The economy was growing like crazy. There was a lot of housing construction, consumer demand was through the roof. It was a very, very positive economic environment. And then sort of the steam sort of, the economy ran out of steam. It lost momentum, and we saw what we call sort of a decline in aggregate demand, and then what turned into a financial panic and a run on the banks as people became increasingly insecure about the state of the economy. In 08, 09, it was very clearly a financial sector and housing market origin, due to toxic mortgage lending practices, particularly in the United States, less so in Canada. But back then, didn't need a job, didn't need an income, didn't need a down payment even, and you could get a mortgage. And isn't it funny how that didn't work out? So very specific origins there that cut pretty deep into the U.S. economy and in Canada as well, and particularly in real estate. And what was the origin of the current downturn? Well, it was basically, we just agreed to close things down. So again, up to the middle of March or the end of March, our economy was on a very, very solid footing. Some contributing factors during the Depression was that there were high and increasing interest rates. And like I said, there was an oversupply of housing because there had been so much construction in the 1920s. The Great Recession, we had over-leveraged households to begin with. Household debt, when in relation to disposable income, was even higher in general than it is today, or it was 2 months ago. And there was, most importantly, perhaps, a lack of regulation within financial services. They were, these investment banks were operating like, Vegas-style casinos, and it really undermined the operation of our economy across the board. And then on top of that, there was a muted, political response because of issues related to moral hazard and this perception that, well, hey, we can't help out these companies that really were the source of this downturn. How can we bail them out? Eventually, a lot of companies were bailed out, but the response was relatively muted and it was relatively delayed. The contributing factors to our current downturn, there were none. Again, we were, finally, I think, turned a corner. Our economy had been running at full speed for a while. We turned a corner in our real estate market locally, in Toronto as well, and then we turned off the lights. Some key features of these downturns: the stock market was down by 1/3 during the Depression. The unemployment rate went up to almost 1/3 of all workers, and gross domestic product, which is the value of everything we produce, from t-shirts to consulting services, whatever, throughout the course of a year, fell by 42% at its low point. During the Great Recession, the stock market fell by half. The unemployment rate doubled in Canada to about 9%. In the US, I think it got up to about 10%. And in Canada, over the 9 months that this downturn lasted in 2008, 2009, we lost 950,000 jobs. Now, in comparison, our stock market is currently down by stock markets. So this is actually the Dow Jones is down by 20%. The S&P 500, I believe, is down a similar amount. The unemployment rate here in Canada is now up to 13% based on the latest data. It's probably a little bit higher than that. GDP fell on a month-over-month basis by 9% into March, and we're still waiting for the April estimate. But again, there's some estimates out there that GDP has fallen by as much as, on a year-over-year basis, by as much as 40% here in Canada. And we've lost 3 million jobs in 2 months. Compare that to less than 1 million lost over 9 months during 08, 09. And anybody out there who lived to work through that period, you remember it as a very severe recession 12 years ago. So coming out of the Depression, they abandoned the gold standard. Governments and the central bank coordinated their response to downturns better. In 08, 09, we saw improved bank regulation that carried us into our current period and actually has provided buttressed sort of our financial supports in 2020. And what have we learned from the Great Suppression? Well, what we've really learned is that our world is very interconnected, whether it's people traveling and living in different places, or it's our economy and the supply chains that matter so much to everybody. It's very, very clear how much we are an interdependent globe and global economy. So how are we measuring the current downturn? As I mentioned, the stock markets generally, indexes are down by about 20%. That's not, there's been a lot of improvement in recent weeks after being down by almost 40%. This has a couple competing effects for our market, because if you're a first-time home buyer, for example, and you're relying on your down payment coming from stocks, you've been saving for a long time, well, you just got battered. And so you might not have enough now to enter the housing fray, to purchase a home. At the same time, you may not want to. Your confidence might be impacted by that. So in some senses, I think some of those first-time home buyers are probably a bit delayed. At the other end of the spectrum, or on the other hand, we have baby boomers who are either retired or entering retirement, and they are conservative investors, and they don't like volatility. They don't like it when stock markets act like my 5-year-old son. And so what they do is they accelerate their maneuvers into real estate, some of their longer term investments. So maybe they downsize a bit earlier. Maybe they they move money out of stocks into income producing properties, residential or otherwise, or they spread some of that wealth that they've built up, that nest egg, over time to their kids a little bit sooner. So there's sort of competing effects of this as well. And we also saw oil prices move negative a few weeks ago. The Canadian dollar is very tied to oil prices. So as oil prices have become sort of depressed, our dollar has weakened. So the cost of US dollars has gone up by about 5% now versus prior to this downturn. And that also has implications for our market. If you have any construction materials coming up through the States are priced in US dollars, they just got that much more expensive, between 5 and 6% to this point. On the flip side, if you're looking at foreign investors into commercial real estate, into residential real estate, well, guess what? Everything just got about 5% cheaper. So again, a couple of competing effects. When we look at GDP in Canada, monthly changes going back 25 years, this is what the picture looks like. So on a month-to-month basis, there isn't like a huge change in our national production. Typically between 1% up to 1% down. In 08-09, you can see that the Great Recession there hitting a contraction max of 1.3% at the end of 2008. But then this whole chart, had to be reworked in light of the data for March, when our economy declined by 9% on a month-over-month basis. So this is very frustrating for me, for someone like me who relies on these charts and these data going forward, because forever I'm going to have a minus 9% on my chart, and it's going to screw up the axis. And I imagine, April is going to look similar or worse. So when you see it in this context, you can see how dramatic this shutdown has been. And one of the responses has been for interest rates then to come down, both as a matter of policy and as a matter of market forces, as people look for safer assets to put their money into. Government of Canada bonds, 5 and 10 years, shown in the gray and the black on this chart, being some of the safest in the world in terms of the security of your investment. But with everybody moving into bonds, into looking for safety and fleeing risk, it's pushed bond prices up and bond yields down. And at the same time, the Central Bank of Canada has embarked on this plan of so-called quantitative easing, where they too are purchasing debt, federal government debt, provincial government debt, even high-quality corporate debt. And so that increased demand from them also pushes bond yields down. So we're basically at all-time lows for bond yields. So as an example, if you had $100 and you put it into a 10-year Government of Canada bond, you get paid 55 cents a year each year over 10 years before getting your $100 back at the end of the day. So yields are incredibly low. And at the same time, the short-term rate, the overnight rate that the Bank of Canada sets, is down to 0.25 percentage point. And we expect those rates to stay low for a very long time. That in some senses has greased the wheels. The whole point with the central bank getting involved in bond markets was to keep those credit channels open, to make sure that funds were flowing and lenders lending. When we look at the residential side of things, that should support things going forward. But we did see in April that resales in this market were down on a year-over-year basis by 43%. So that has been the headline that we've seen in most places. Another way to look at this, and I'm stealing a line a little bit from a friend and colleague, an industry peer, John Bennis, who's a principal at Urban Analytics, who said, another way to look at this is that there were 1,778 buyers that chose to participate in our housing market made a huge financial decision in April of this year during the greatest pandemic we've seen in 100 years. So there is a degree, depending on how you want to look at this, through my eyes, there is a degree of resilience in our housing market and confidence in it over the long term. As we look at the year-over-year changes in April now, you saw what it was like in March in sales. Everything's red because everything's declined. So again, where we had seen some momentum in demand, we now have essentially lost that, not surprisingly. When we look at inventory, it is down 34% on a year-over-year basis. And this is a really important feature of the housing landscape, at least, because so much attention is paid to the demand side, the sales side. And with sales being off so much, everybody says, well, have prices come off? And we'll get there in a minute. But you can't talk about prices without talking about both demand and supply. And so yes, demand has come off, but supply has come off a similar amount as well. We're not seeing those distressed listings to this point. I would say largely based on the fact that we know that this downturn is transitory, and we also know that governments and the central bank have really leapt in with both feet and are looking to support individuals, households, businesses through this. So for now, what we're seeing is just a lower sort of equilibrium in the marketplace for demand and for supply. Supply has decreased throughout the region. So continuing now sort of that, we're at 8 consecutive months of year-over-year declines in inventory that we're seeing across the board. And so this is where the conversation becomes quite nuanced. So this is the change in average sold prices in April. The red bar shows the year-over-year change. The gray bars show the month-over-month change. So out to the right there, you can see that average prices for all property types and for each individual property type are up versus last year, right? And that's on the back of the momentum that was established at the back end of 2019, the beginning of 2020. But if you look at the change between March and April of this year, they're down across the board. And so you look at that and you go, oh man, property values are down by overall 4.1%. Well, not necessarily. And the reason I can say that is that the average is influenced by the mix of homes that sell. So if a lot of luxury homes sell in one period, but not another, you could expect average prices to come down. Or if a lot of inexpensive condos sell in one period and not another, you might expect prices to go up, but it doesn't mean that the value of a particular home has changed by that amount, either up or down over that period. So that's where we turn to benchmark prices, which are, hold the features of a home consistent over time. And what we see here, so it's not influenced by these high value or low value properties selling in one period or another. On a month over month basis, the gray bar to the right there, we saw all property types, the benchmark price increasing by 0.3% in the most recent month. And so we're seeing values generally be supported, but what we're, by way of looking at the average prices, we're seeing activity in the marketplace move down the price spectrum. A lot more activity in that sub $1 million price bucket, and a lot more competition. About a third of all our deals in the last couple of months have been multiple offers. And in many cases, the price has been pushed up, the ultimate selling price above what was being asked. So an interesting dynamic to this point within our marketplace. And you can see benchmark prices generally in the most recent month have increased in our region. But all the changes are relatively modest one way or the other. The final thing I want to discuss, and then we'll open it up to some questions and a conversation with Ashley as well, is how our employment picture is changing. Because I think this is really important if we want to understand truly how people are being impacted right now, and also about where we're going. What does this all mean? So this is the month over month. So it's monthly changes in employment in Canada, all jobs, going back to 1976. So the entire data stream. And you can see that just like with GDP, you're kind of constrained either, at the very top side, you get 100,000 job growth in a particular month, or you lose 100,000 jobs in a particular month. But outside of that, there's the variations all within that range. That is until we hit March of this year. So the chart that you're seeing now is exactly the same data from the previous chart, but just with a different axis. And you can see that at the end of 2008, we had our all-time biggest loss in 1 month of 120, almost 5,000 jobs. And after adding 30,000 jobs in February of this year, Canada shed just over 1 million jobs in March, and then an additional 2 million jobs in April. So a total of 3 million jobs were lost across the country since the beginning of this pandemic, and 400,000 of those have been in British Columbia. And so what we've seen in Canada and BC after years of a declining unemployment rate, with Canada having hit just under 9% in 2009, we were all the way down. Canada was sub 6%. We were sub 5%, close to 4% in some months. And now we've seen the unemployment rate nationally rise to 13%, just below that for British Columbia. So we continue to have a little bit of a tighter labor market here in BC, but not much. Conditions have worsened dramatically. In Metro Vancouver, we went from essentially the unemployment rate floor of 4%, 4.5% up to 7.5%, and then 10.8% in April. So the Vancouver market is a little bit tighter and better functioning at the margin than the provincial one and the national one. But again, we look back over history here, and we've never really seen an unemployment rate like this in this region. And that's through the loss of 250,000 jobs just in Metro Vancouver. Those numbers are what capture people's attention initially. It's what generates the headlines because they're big, dramatic numbers, like almost quite literally off the charts. But I think what matters to us more is just digging beneath the surface a little bit and trying to better understand how our employment is changing, not just by how much. So one feature of our changing employment landscape is that part-time jobs here in BC, that sector of the economy, has sort of borne a disproportionate burden of this downturn. So 43% of the jobs that have been lost in the last 2 months in BC have been part-time. And so more jobs have been lost on the full-time side than part-time, but part-time typically only accounts for about 23% jobs. So we're getting twice the proportion of jobs lost on the part-time side than they normally account for. And that is in stark contrast to what we saw in 08-09. So back then, in fact, 128% of the job losses over a 9-month period were in full-time work. So even more full-time jobs were lost than total jobs because some of those full-time jobs became part-time. This is a little bit different, and that has, I'll get there in a second, it has implications for our recovery. On the sectoral side of things, 90% of job losses over the past 2 months here in BC have been in services. That compares to those types of jobs accounting for typically 80% of jobs. So we know that we're overweighted on the service side of things, bearing the brunt of this downturn. And not surprisingly, when we break that down by more detailed industry sector, what we see is that the data confirm what we think we're seeing with our own 2 eyes and what we're hearing. And that is that trade, so that's retail and wholesale, and then also accommodation and food services are the sectors that are being hit most by this current downturn. So what are we talking about here? Retail shops, yeah, Robson. We're also talking about restaurants. We're talking about cafes. We're talking about hotels. So the picture that emerges is that it's part-time service work. We also know that about 50% of the job losses are under the age, the people who have lost their jobs are under the age of 30. We have young part-time workers in the service sector that have, to this point have really accounted for much of the loss. And that's what we need to keep in mind when we look at where we think this might be going. So, the economy is not done evolving yet, but we're 2 months into this and we're probably getting close to the floor when we look at some of these metrics. And what we've seen on the other side of the ledger is an unprecedented response. I know that term is so trite in these conditions, but it is totally unprecedented. The coordinated provincial and federal response, as well as the Bank of Canada and then other financial institutions as well. So we've had the federal government spend almost $300 billion supporting landlords and businesses and individuals to get through this. And we've created a liability for ourselves of about $15,000 per pre-pandemic employed person. So in other words, if our employment got back to where we were before March, we'd all have a liability on our heads of $15,000 that we either deal with it through increased taxation or we don't. And we look to stimulate economic growth and we deal with a permanently higher debt level. But we've seen the provincial government, support or generate, implement, complementary policies that the federal government couldn't or didn't address. And then the Bank of Canada now has committed to interest rates being low for a very, very long time. We can talk about that a little bit later if there's time. So all of this, when you look at the nature of the downturn, the pursuit of a vaccine, the composition of employment losses, in the context of this rapid and extraordinary financial response by governments and the central bank, this is something that gives us hope going forward. But of course, not every sector will rebound in the same way. Like the example I've been using is, the restaurant industry. It's going to take a long time. They were the first to pack it up, and they're going to be maybe the last to unpack and get back to so-called normal when we're done. That sector is going to be hurt big time, because if I don't eat lunch yesterday, I don't have 2 lunches today. When you look at real estate, particularly on the residential side, which is what I do, I look at it and I see people who were in the market for a home before this pandemic hit, even during the pandemic, and maybe they've hit pause, but they still had, either the kid was on the way and has been born, or they had a newborn, or people just got married, or we know divorces are going to go up through this period. We might even see a mini baby boom. And so what I'm saying is we paused a lot of things, but we don't pause how our demographics are changing, and particularly we can't pause aging, unfortunately. So where there were housing needs before this downturn, they still exist. And so there's just a delayed response of participation back in the housing market. So I do think that we will see resale first, followed by pre-sale, residential market lead the recovery going forward. And then just to wrap up, and then we can go over to questions, just some thoughts on where we're going, what we're looking for, and questions that we're asking, which really run the gamut. Whether we're talking about it is the world of commercial real estate, or it's pre-sale, or it's resale, or it's just sort of broadly macroeconomic or cultural. There's so many questions to be addressed. And we are in the thick of this still. We don't know the answer to a lot of these things. I would say I'll go on a limb here and address interest rates, and then I'll shut up. There's so much uncertainty right now, but if I had to put my money on one element of our economy going forward, it would be on interest rates being low for many years to come. I was saying that before we came into this unexpected shutdown. And I'm doubling down on that now, because the Bank of Canada has effectively said, the overnight rate at 2.25% is as low as we're going to go. And that is the floor. So they're not going to adjust that anymore. And in previous times, when they've stimulated the economy through a decrease in interest rates, they've left them there for about 2 to 3 years. So short-term rates, which influence lines of credit and that kind of thing, car loans, those are expected to remain very low. But what's different about this time versus previous downturns or previous interventions is that the bank has said, we are going to keep all interest rates low for longer. In fact, we're going to keep them low through bond purchases well into the recovery. So they've committed to that. So we can all bank on the fact that the interest rate environment will be managed through a combination of policy and market forces, and that we'll see that borrowing environment remain conducive to the amount of debt, let's say, that we've taken on going forward. But otherwise, maybe what I'll do is send this back over to Ashley. That's sort of my take and our take on where we're at right now. And maybe there's some questions that we can address.
Great. Thank you, Ryan. Can you guys hear me okay again? Good. Okay. Well, Ryan, that was a wealth of information, and we are 9 weeks into this story. We know we have a long way to go, and our learnings are just going to continue through this. 2020 by any means is not going to be a year that we forget. So with that, what I have, there's a couple questions coming in, but what I'd love to do is, and I don't know if this is easy to do now that we've switched, but can we go back to the slide that Ryan had with some of those thought starter questions on there? Because thank you, because I think there's a lot of great thoughts here. And as I said, we are all in the beginning of our learning and discovery and figuring out what this all means for the physical product of real estate and emotionally how people buy. But I thought we could start off with a question just around how we think this is going to affect certain asset classes. So one of the questions you have up here is office space. Has this use changed forever? And Ryan, I know that you and Rennie focus on the residential market, but what are your thoughts in terms of what the longer term impacts could be when we look at whether it be office, industrial, retail, and or other aspects of residential?
So, I mean, specifically on the office, I would say more generally, I'm generally not a cynic. I am skeptical of humans to dramatically change their behavior permanently. And I sort of look back to, as a result of events like the one we're going through right now. So I look back to 2001, 9/11, and after the World Trade Centers were hit, we said, oh, well, no one's going to lease space in high rises. No one's going to live in high rises anymore. What did they do? They built an even bigger tower on that site. And of course, all of us, many of us live in high rises. We work in tall buildings. I do think that I also look at the jobs that are expected to come into Vancouver, and as far as I'm aware to this point, there hasn't been any major change of strategy or plans by some of these larger companies like a Shopify, like an Amazon, Microsoft, as they bring jobs, as they add office space to our current market. I think that there is a lot of talk about this notion of working from home. Well, now everybody's comfortable with it, so we're going to do a lot more of it. I'm not sure if we will. I think that maybe at the margin there is less need or we don't need as much space per employee going forward. But I do think, especially for those of us in the service industry, where the relationships with our consumers and our clients is so important. I also think that if you're going to have strong relationships externally, you've got to foster a certain environment internally where people are able to work directly with each other. They aren't hot desking. There's a lot of literature out there about sort of the efficiency challenges associated with the connection to company, employer, of hot desking and not having a fixed workstation that is yours. So, short term, I think we'll hear a lot of conversations about the changing need for office space, and maybe we need a little bit less. I've also heard, well, maybe, some employers expand into more because they want to increase the distance between workers. I think some economics, the reality of the economics of that come into play as well. And I think that, we're going through a period where we're off trend and the perspectives on this are many, but my feeling is that we'll move back to sort of, where we were prior to all of this, in the next 12 to 24 months. And actually, I don't know if you have any thoughts on that specifically.
Yeah, I was just going to say, I'll jump in and add a few thoughts. For those of you that know me, I work across industrial, residential, and commercial. And I've actually been looking for my commercial projects, looking at what the stats are. And I agree with you. I think, there is going to be more people working from home, but offices are going to need more space. So I think we're going to net out somewhere there. And I do think, we are going to migrate back into in-office environments. And I'll just share some stats around where our office market is at. So pre-COVID, so looking mid-March, we were at the lowest office vacancy rates we had seen in 11 years. So downtown office was at 1.3%, which isn't really qualified as a vacancy rate because it's mostly on turn and such. If we add in suburban office to that in Metro Vancouver, we were at 3.7%. So we were seeing an office environment where people were struggling to look for space. For those of you that know the Vancouver market well, we've also been seeing a boom in terms of construction around office. But the recent stats show that 75% of the product under construction has either been pre-leased or pre-sold. So we do see, we're coming off a very constrained office market, which despite if we see changes, and as I say, they will net out from the increased need for space, I think we'll still be in a pretty healthy office environment. I do think that we're going to compete with a sublease market that we don't usually see in Vancouver, because we are going to have businesses that fundamentally just cannot make their rents. So I do think, though, the trick to getting our offices up and running are what we do on the technology integration point of view. So looking at sensors and touchless technology and such, which which is a hot topic. And I know that from a private sector developer point of view, we're looking at it across the board for anything that's multi-tenanted or family. And that's going to be a big part of keeping those markets healthy. Yeah. Brian, do you want to touch on any other asset classes before we've got a couple more questions that I'll run to, but whether it be changes that we expect to see in retail or residential?
Yeah, I think, one thing is that I think we're seeing everywhere is that the changes that have been precipitated by this shutdown have accelerated trends that were already in motion or already established. And I look at this is a little bit anecdotal, but we know that there has been a shift over time away from bricks and mortar retail to online. I think that what we're seeing more of now is actually more of that functional online shopping, where you're seeing people buy those staples that they wouldn't have normally purchased on an Amazon, setting up regular deliveries of those types of things. So I do think the retail landscape is going to be impacted. It's also a sector that is dependent on, particularly in the Vancouver market here, on tourism and tourism dollars. So, we know travel has been absolutely decimated. I think people might get more comfortable with returning to stores. We've seen lineups in Toronto as they're opening up. Aritzia had lineups around the corner. So people are obviously prioritizing, clothing over any concerns they have about health, even in the short term. But I do think that the tourism dollars, the visitor dollars, are not going to be there in the way that they were previously for a long, long time. So I think there will be some challenges there. And I think on the multifamily res side, the rental side, that there's, no doubt there'll be short-term cash flow issues. I know most of the owners that or managers that I've been speaking to over the last couple of months, their rent recovery is in the range of 90 to 95%. So there hasn't, and that's for April and for May. But of course, that's in the context of these, extraordinary financial supports for, on the one hand, a little bit for landlords, but also for tenants. And so the question is, what does the landscape look like going forward 4 months from now, 5 months from now? So I think we might see some short-term cash flow issues, but I think that sector is stable. We will see immigration return to levels that we were at pre-pandemic within the next couple of years, is my guess. And so I think the demand will be there for rental. Is there anything you want to add to that, Ashley?
Yeah, I can add a couple of, right now I'm involved in 2 lease-ups of new rental towers. So they're all over 220 units. And we've actually seen absorption going relatively well. And one of them we started leasing 2 weeks ago. So during COVID times, and we're actually pre-leasing that. So, on the residential side, whether it be sale or rental, though, I have seen some changes. We've seen people that were previously interested in being on higher floors wanting to gravitate to lower floors, so they're less reliant on elevator. And we have seen the consumer start to ask about touchless technology on any kind of common doors and such. You have a note on the slide here, which is the future of the townhouse. And I do think we've been undersupplied in townhouse in our region for a very long time. And we're going to see way more pressure on that asset type, as well as anything low rise. The other thing that we're seeing is, although there was a small premium to outdoor space, whether patios are connected, walkouts and such, but now, we are seeing an increased premium on that, and those really being functional spaces. So I think it is going to lead to some good innovation on how we experience residential.
I would agree with you, Ashley, on that. I think that there are a lot of, I think what's front of mind for people right now is this notion of, how long could I hunker down in this space? How safe am I in this home? If I'm to rent it, if I'm to buy it, if I'm to buy it as a pre-sale. So I think more space matters than less, and that matters more now than it did before. I think the delimitation of the homes, how they're laid out, how big is the bedroom? Like, does a 90 square foot master bedroom work anymore? If that's the place that you need to be working in, do you have enough storage? Is there enough delivery space in the common areas? And what do those common areas look like as well? And we talked about amenities, like, we've been talking about these big open spaces where you can drink wine and do your laundry. And now are we, or does the pendulum totally swing and we move to like library carrels that are set up so everyone has their own private space? And I think the answer to a lot of that stuff is, I think as either developers or, representatives of developers or as salespeople, we need to be aware of what the consumer is thinking about and what they want now. But I also think that the pendulum will swing back, and we will. I think touchless technology, it's kind of a no-brainer. We're going to see that implemented going forward, but I think a lot of the things that are front of mind for consumers right now in residential real estate will abate slightly over time.
Oh yeah, no, I totally agree. And we've got a couple other questions here, so I'm going to get to them, but I'll just add to that quickly. One of my projects, we just started construction on 12 townhomes, just started about 3 weeks ago, and we're not even pre-selling them in Kitsilano at 7th and Arbutus, and I've had over 50 requests for those to date. Just even our construction team on site is getting them, just looking at that townhouse product. And when we're looking at rental, people are wanting to move from 1 bedrooms to even 3 bedrooms right now if they can afford it, because they're thinking in an environment where they're homeschooling and also both could be working from work, although we are starting to see things open up. For those of you, because I see some names on our chat, on our participants today that are industrial, and as Ryan knows, I'm heavily involved in industrial strata and lease on my project, so I'll just touch on where we are with industrial in our region. We're a landlocked region, and that really affects our industrial land supply, which was low to begin with. So at the end of April of 2020, our industrial vacancy rate was at 1.5%. Basically, we build stuff in industrial here and it absorbs. If you look at our product supply under construction, I'm going to check my stat here, 70% of the projects under construction slated for completion in 2020 or 2021 have already been pre-leased or pre-sold. We are seeing a huge increase on warehousing and distribution, of course. That is a byproduct from what we're seeing in change of consumer patterns during this pandemic. And so if anything, I think, we need to increase how we build industrial and look to more intensified stacked industrial to kind of satisfy that demand moving forward. So one question here, I'm going to turn it back to the residential side because we had a question come in and says, how do you see the pre-sale market returning? And what is the future of presentation houses or centers? And Ryan, I don't know if you and rennie and the team at rennie have been talking through that and have any thoughts around just what we may see around that in the coming months and years.
Yeah, I do think that this gives us an opportunity to reassess, all of us, how we do business. And question we've been asking ourselves is, do PCs reopen on a 6 times per week basis? Or are they more, do we move more towards appointment only, open, 3 to 4 times to the public per week? How many virtual tours are we doing? I do think that whether some of these changes that are being contemplated actually manifest themselves into a structural evolution within our industry, it's not clear yet because we're all just sort of re-expanding into the space now. But I do think that, on the pre-sale side of things, we were in the first quarter of this year regionally, we were on track to more or less a little bit exceed our total for 2019. Obviously things have slowed down quite a bit. I believe that we have written in the past 2 months 60 to 65 deals. Bob Rennie's been saying if we had done that last year, we'd be slitting our wrists. But this is it's a different market, and what that shows is that for the right product, the right quality, and the right location, obviously the right value, people are still confident enough to put money down now for a product that's delivered in 4 years. But one thing I'll say, and then maybe actually you might want to weigh in, is I really believe that a healthy pre-sale market is predicated on a well-functioning resale market. I think that price expectations are established in resale, and I think we don't yet know what that trajectory of prices is. So, we look at resale. I think by the end of the year, if we're able to expand back into our economy in a reasonable way by the end of the year, I think resale will recover relatively quickly and probably lead the recovery. I think pre-sale is probably about 12 to 24 months out from there. And I think the $2,000 a foot price point is gone away for now, and that buyer is going to be targeting more in that $1,000 to $1,500 range. Ash, do you have anything to add?
Yeah, I agree. Resale has to be strong for pre-sale to gain its strength again. I do think, though, that we've seen projects we put on hold and we're going to get into supply issues once again. It's just a question of when. And that's going to return us to a healthy market. And I've been using the 12 months. I think in 12, we're going to have, 12 months of kind of interesting market conditions. And then I think 18 months from now, we are going to be into some supply issues on product that people want to see.
I totally agree on that.
Yeah.
I just,
I'll just other questions. Sorry.
Oh, yeah, go ahead.
No. And I just, you know what, we're not going to be able to answer them all because we're at time. But, what I was going to suggest is maybe there's some really, really good ones here. And I'm wondering if maybe Ryan, you and I can respond to them offline through the chat to people.
Sure, happy to. Yeah,
but did want to see if there is any closing comments. And one thing I will say, sorry, on the question that we were addressing on the presentation houses question. One of my friends and colleagues in the industry, I don't know if she's on the call today, but Mandy Newton with Adira, she used this expression, let's not waste a good crisis. And one of the amazing byproducts that I have seen from the sales and leasing and marketing point of view is tons of innovation very quickly on how we do that. So one of my projects, the Mark, which is on the west side of Vancouver, we just launched our virtual PC. From our PC with interactive chat and so on and so forth. So, that's one of those innovations out there. But I mean, I think you can look at any project website right now and just see great use of whether it be AI or VR or sliced video content and such. So I do think, I give a credit to our entire industry of how well we've kind of, innovated and reacted on that front. Okay, so with that, tons of great, I want to thank everyone once again, but particularly Ryan for your time and expertise. As I said in the beginning, 2020, a year we're not going to forget, and our story is still continuing. I do think we get stronger by sharing and learning from each other. And with that, just keeping on my son's obsession here with Back to the Future, I'll leave with some humor. And this is actually my first day in 9 weeks in the office, so you've probably seen some people behind me. I did do the forte to the non-elasticized waist pants. And I saw this and have to share because I know many of you are still working from home. But again, Dr. Marty from Back to the Future, pants where I'll be working from, I won't need pants. With that, Ryan, thank you for joining us from home. And we have so appreciated. And to all of our crew members and sponsors today, thanks again for your support. And we're always here if you have any questions.
Thank you.
Here, guys. Bye.